But we also have to bear in mind that deciding not to act isn't the opposite of acting. It's an act in itself. The decision to not act, to leave a portfolio unchanged, should be scrutinized as critically as a decision to make changes.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome, everybody, to the Skippy and Doogles show. This is the podcast where we talk about, this is two real investors, two friends for a long time. We talk about business, we talk about economics, we talk about what's happening in the markets, and bring it to your mentals, what two investors are thinking about what's going on right now. That's what we do. If you have not, please stop right now and go rate and review the podcast. Follow us on Instagram, follow us on Twitter, X, follow us on YouTube. It's all at Skippy Doogles. Go do that. We love it. Here's what we got in store for you all today. We're going to talk about some Charlie Munger, drop some knowledge from Charlie Munger, capital allocation, the latest Howard Marks memo. We're going to drop some knowledge about that, and then round out everything with listener mail. We have gotten a slew of listener mail over the last couple of weeks. Sorry if we don't hit on all the listener mail, but we're going to drop knowledge about 3 of the listener mail pieces at the end of the episode today. You ready to get into it?
So much listener mail, we can't keep up, but we appreciate it. Thanks for sending it, guys.
I said, are you ready to get into it?
Let's go already, okay?
When I ask you questions, you answer those questions.
You know who I thought of this week, Doogles? Our boy Charlie Munger. And how he would react to today's current situation.
I would love to see it. I would love to see it.
Yeah, I would pay infinity dollars to be in Omaha to hear him throw some shade at all the uncertainty that's happening right now. Like, it would be,
yes, sir.
His one-liners about this would be amazing. But here's the deal. Charlie Munger is famous for so many reasons, but one of his notable investing thoughts right before his death was a company called Alibaba, right? He talked about it when it got really cheap. He said, this is the way to go. He said, I'm not scared of Chinese stocks at all because it's in the best interest of the United States and China to work together. That's how world harmony will be achieved.
That's right.
Okay.
What was the first episode of this podcast called?
I don't know. I have no idea.
No one's ever gone wrong by buying a Chinese stock.
Right? For those who don't know, 4 years ago, Doogles has some history with Chinese stocks and the government intervening in a way that reduces the value of a company significantly overnight, right?
That's right.
And
that's
so
right.
Every time we've talked about investing in China on this show, we've always said, there's some problems with that. One, if it's U.S. listed, it could potentially be delisted. 2, the Chinese government likes overreach. I don't know how else to say it. And they're only going to allow your company to make money if they choose that your company can make money. So for my Chinese investments, my Chinese stocks that I've invested in over the past 2 or 3 years, I've always been apprehensive about all these things. What I never thought would happen, Doogles, is that the U.S. government would hate my Chinese stocks as much as maybe the Chinese government would, right?
They hate them so much.
Just last week, Scott Bessent, the Treasury Secretary, now this appears to be posturing, but he was asked about if delisting Chinese stocks were a possibility. And he's like, oh, yeah, of course, absolutely, right? That sounds like the other side of the Pacific, not this side of the Pacific.
No. It's because the man's he's telling it like he sees it. Anything is possible. Like, you could ask him any question. He'd go, yeah, that's possible. Like,
that's possible.
Do you think we could just like kick Wyoming out of the Union tomorrow? Yeah. That's possible.
Definitely possible. Yeah. All right. So this ultimately ties back to a really famous Charlie Munger quote. It's all Munger to start the show here. Never erupt compounding unnecessarily. It's always hard for me to say. I'm going to say it again.
Say it again.
Never interrupt compounding unnecessarily. It's a great quote.
Say it a third time.
Never interrupt compounding unnecessarily. What do you think Munger's take would be? Because I'm pretty liberal on trying not to interrupt compounding unnecessarily. When you have a worldwide trade war between two 70-year-old people who think of them as dictators who happen to run the world's largest economy, and this is not doom and gloom. We're past that. We're having fun. We're tagging investing. But this week, what happened is the U.S. would raise tariffs on China, and then China would raise tariffs on the U.S. I sent you a headline from the New York Times that said China is mocking Trump with the latest Treasury raise. So the current tariff rates, this will change by the time you listen to the show because it changes every 7 seconds, are like 145% for the U.S. and 125% for China, something like that. They're insane.
Yeah. So the quote, which you repeated many, many times, which I appreciate, is not never interrupt compound.
Unnecessarily, it's what it says. What's the quote?
It's not is never interrupt compounding. So that means there are sometimes, according to Mr. Munger, there are sometimes we go, oh, what's necessary?
That last word. Now, I just wish I could sit down and have a cup of coffee with the guy because I don't want to. I actually really like my Baba holdings. I really like my JD holdings. I really like my Yum China holdings. And China, as of last week, was the second cheapest stock market in the world. I've made really nice returns in China. I have no desire to interrupt my compounding there. But I kind of feel like this is what that fourth word is talking about. Like, there's no reason for these two people to make sense anytime soon. As I say that, it will probably happen next week. But it's like absolute craziness going on out there.
It could happen any minute. The Chinese holdings you were just talking about are either going to drop or increase by 30% in the next 3 weeks.
Yeah, right.
And who knows? It can go either way.
So what I'm leaning towards here is, and this is why, listen to the listeners who aren't active investors who pick individual stocks. This is a blessing for you guys. You don't have to worry about any of this. Just invest every 2 weeks, call it good, and go for it. But when you're actively managing a portfolio and trying to make these decisions in real time, at the moment I lean towards kind of selling half.
No. Okay, dude, this is very simple. Here's the thing. I'm going to educate you right quick. First, a question. If you zoom forward 5 years and you look at your portfolio and you're holding the stocks you just talked about, will that make sense to you? Like, it just in general, you'd be like, yeah, it makes sense that I'm still holding these in 5 years.
Probably not.
Okay. That's an important question, because if the answer was yes, then I just go like, all this is going to come out in the wash over the course of 5 years. If you're looking for more of like a 1 or 2 year thing, then the path that you're going down makes sense. But half, I don't know. I think it's you're either making the bet or you're not making the bet. That's what I'd say for this. I wouldn't say that for everything. But for this, are you making the bet or not making the bet?
I think we can agree to disagree there. But this leads to my second point, which I think is so fascinating right now. And it's really a capital allocation decision. So before I talk about capital allocation, I want to talk about two things. One, uncertainty has exploded in the past 3 weeks, like we've basically never seen. So there's a graph in the Financial Times right now that is the University of Michigan it's the U.S. Economic Policy Uncertainty Index. Typically, this hovers around 100. During the pandemic, it went up to like 550. It's currently off the chart at like 900. Like, the uncertainty in U.S. policy right now is like nothing we've seen in the past 20 years, and maybe nothing we've seen in the past 50 years. Okay? So I have told you, and one of my strongest held beliefs is that who the president is doesn't impact stock returns. And that belief was shattered 3 weeks ago.
I laugh at thee.
I would have told you that the past 100 years, I don't care who's in the White House, stocks are going to do their thing. It's based on valuation. It's based on inflation and the economy, 1,000 other things, right? I would tell you who's in the White House does not matter.
Can I interrupt for one moment? Because I'm going to bring this back to a business context. So I was having a conversation, this was probably like 3 years ago. I was having a conversation with a direct report of mine. And I was asking them about basically the business they were running. part of the business they were running. Asking them questions. They were giving me information. I kept diving a little bit deeper, a little bit deeper, a little bit deeper. And they asked me this. They said, how much detail do you need to know before you feel comfortable about what I'm doing?
Yeah.
That was the question.
It's a good question.
Yeah. And I said, I'm actually not asking these questions because I need any more detail. I want you to give me the amount of detail that makes me believe that you know and you believe in what you're doing.
Oh, I see. You're a bad boss. Come on. That's a great joke. Come on now.
I'm out, people. No, but this is, that's good. But the reason I bring that up is because what you're talking about, the uncertainty, is that the more detail I hear, if I put in that same situation, the more detail I personally, Doogles, the more detail I hear from the administration, the less I believe that they know what they're doing. And so I think that I don't think that I am alone in this. I don't think I'm alone in this. And so I think that there's a huge part of uncertainty that's being driven by the fact that there are people that are like, going back to what we just talked about, we were joking about a minute ago, people like anything could happen at any minute.
Yeah.
And so therefore, how can I be certain when you're not certain? Like when you don't know what's going on, how can I be certain?
It's a fair take. And even if we pull it away from the administration specifically, the American Association of Individual Investors, 62% of the AAII believes that stocks are bearish. Travel from Europe to the U.S. has collapsed. We talk about travel from Canada to the U.S. collapsing. Like, these are material things. I'm talking like down 30%, right?
That's right. Except
So,
Iceland.
Iceland still loves the U.S. This is great.
Yeah.
Apparently they hate Greenland for all I know. But the question is, right? Like, I normally would not spend any thought on this because normally I believe I'm basically fully invested. I'm not trying to time the market, right?
Mm-hmm. Yep.
That's just, I'm going to buy what's cheap, roll with it. At the current moment, I have cash, like not a ton of cash, but like 20% of my portfolio is cash. I believe cash is really important right now. And my question for you, Douglas, the fascinating thing for me is there's some names I like. There's actually a fair amount, 10 to 12 names that I find interesting right now. And so I get to decide how to deploy that capital, whether it's a big bang or whether it's dollar cost averaging over 6 months or 12 months or whatever. And I really find myself fascinated by this decision because there's no great headlines that say you should deploy capital right now. And like, if you talk about the S&P 500, I would not deploy capital blindly into the S&P 500 right now because the S&P 500 isn't particularly cheap. There are certainly some names that are bordering on dirt cheap, but there's no name right now that's like, this is the deal of a generation. There's some names that are pretty intriguing.
Yeah. Agreed.
How do you think about this?
So how do I think about it? How do I think you should think about it?
Both. Start with you.
Okay. So for me, I think there's one, going back to the question I asked you earlier. In 5 years, would you be cool? Would you make sense to you that you're holding the stock? If the answer is yes to that for any of these names, then I go, yeah, deploy. Because it's like, because that's a different calculus, right? You're saying like, is this a good price for the stock?
Let me clarify. I'm actively deploying. The question is, if I actively deploy 100% of that cash, or if I actively deploy a small portion of the cash and like get fully deployed in the next 6 months or 12 months.
Okay, yeah. Sorry, I missed the question. I would not do 100%. I would do some version of DCA. Yeah.
And I kind of hate it because I love being like, it's easier to talk about a name. I love being like, Nike's at $55 a share. I want that. Throw my big investment there, write it out. Really don't even watch, just move on. But man, when one day there's a 47% tariff on Vietnam and the next day there's a 10% tariff and the third day you have no clue what else, like Nike could be worth, depending on the political circumstance happening here, could be worth $30 a share. It could be worth $180 a share. Honestly.
Yeah.
I truly believe that.
But it would be really hard for Nike to be worth $30 a share in 6 years. Like, it would be really, really difficult. It's not impossible.
Agreed. It's certainly not impossible. But here's what happens. Let's walk you through doom and gloom. Doom and gloom is not how you make money in investing, right? Pessimists don't make money, optimists do. Understanding historical events is really important. If you think about the start of this year, we told you, and a bunch of other smart people told you, U.S. stocks were expensive, international stocks were cheap, and at some point that was going to correct. We've really seen that start to correct in the past 3 weeks.
I disagree.
Okay, go ahead.
Okay. From a price perspective, you're right. But the reasons that the prices are changing are really important. Because what we were talking about at the beginning of the year was more that there was a macro shift from U.S. to international that has to do with valuations, opportunities, etc. What we're seeing over the last 3 weeks is much more so just a anti-U.S. movement, which is very different. You can maybe the same outcome, but that's a very different thing.
No, I don't care about the cost. The outcome is what I care about. Like,
no,
I told you the U.S. dollar was overpriced, and it went down 10% in the last week.
Yeah, but
which
the
is making my European vacation very expensive, by the way.
My God, it is, dude. When we were just in Paris, right? When we were planning to go to Paris, there was a 1-to-1 situation going on. But when I was in Paris, the euro's 10% higher than the dollar. It's a big difference.
And now it's even higher than that. You just wait.
Yep.
But whatever, I'm going to go support the European economy this summer.
The cause matters because that is what could lead to whiplash or not because of the cause. If it's like a real shift, it's much less likely that there's going to be whiplash. But this is different.
Here's ultimately what I'm saying. I'll try and summarize it really succinctly, and then I have one more point. When the uncertainty index is at like multi-decade highs, unfortunately, I have to take that into account with how I deploy capital. If the uncertainty index was at average levels and I was seeing some of these opportunities, if Nike was at $55 a share and no one was talking tariffs, or some of the oil companies were in the range they're in, but the price of oil wasn't collapsing to the point where it might make sense to cap their wells, I could go on and on. There's all these intriguing opportunities out there, but the uncertainty is too high to like write the massive check. I think you have to put a tiptoe in.
This is a perfect transition into the Howard Marks memo.
Let's do it.
Is it not?
It is.
Is it not? Okay. So Howard Marks, we love Howard Marks on the show, y'all. People, you know that. So when he comes out with his memos, we generally end up covering what he talks about because he's dropping knowledge in those.
One of the memos we talked about 2 years ago with Howard Marks effectively said, he's a credit investor, right? And he said, look at high yield credit right now. I think it's mispriced. You can easily make 9% return with very limited risk and do that. Part of the reason I'm sitting on more cash than I typically would, because I took Howard's advice. I bought that. It paid me a 7% dividend for 2 years. And then I looked at it recently and said, this isn't the deal it used to be. So that was exactly my plan all along, but anyway, the point being, Howard can make you money time and time again.
Yes, sir. I was texting you about this yesterday. I know you don't like it, but what he's talking about is I was looking at some corporate bonds this week, and Petróleos Mexicanos, their bond yields have spiked. It's over 9% right now. That's the kind of thing he's talking about, whether you want to buy that particular thing or not, but that's what he's talking about. He's saying that there are yields in places for companies that, like that organization specifically, founded in 1938, been around for almost 100 years, like probably not going anywhere. Generally speaking, when you have companies, Howard put out something that said something like 98% of bonds end up getting paid out. It's something like that. So when you look at this, he's just like, yields are spiking to rates that are like pretty juicy right now. And if you're going to buy something that's paying 9+%, that feels great. And you have, as you discussed, uncertainty in the stock market, it's worth a gander. That's what he's saying. All right. This memo, nobody knows, parentheses, yet again.
It's really part 3.
Yeah, part tray, that's right. The reason it's part tray is because he's written 2 of them before, and he acknowledges that. What he's saying, there are some, I think, juicy quotable notables in here. I love them. The general theme, the general premise behind what he's saying is you don't know the outcome of these situations when uncertainty's high. People that are trying to predict predictions, phooey to the predictions. When people say analyzing the future, that's just a bunch of haktua is what he says. But acknowledge the chaos, then invest despite not knowing the outcome.
Mm-hmm.
I love that quote. Now, the wrong way, I think, to take that, going a little bit back to the conversation we were just having, the wrong way to take it would be, oh, okay, I don't know what it's going to do, so I'm just going to dive in, right? Like Leroy Jenkins. That is not what he's saying.
Shout out to Leroy. I liked the story in this memo. There's so much to like about this memo. First, I will say, I just thought it was incredibly thoughtful and well-researched. And he straddles all sides of these issues. He really comes with an open mind and says, like, let's see if there's a way that we can put a positive spin on some of this tariff stuff. Unfortunately, his research proves not really. But the first time he wrote this memo, nobody knows, I think was 2009. And he was just saying, it's tough out there, guys.
Yep.
But at Oak Tree, we raised a opportunity fund to take advantage of the most distressed assets at the most distressed time. So I have two options right now. I can not invest and say the world is going to end, or I can say things are crazy out there. This is why I raised the capital. It's scary and no fun. I'm going to deploy that capital now.
Yeah. $10 billion.
He did the right thing.
Yeah. One of my favorite investors, I don't like to give you any kind of accolades. One of my favorite investors, his name is Skippy. He once said, and I love this, he once said, when things are cheap, they're generally cheap for a reason. There's a good story behind it. And that's exactly what Howard, I think, is saying here. He goes, when you have all this uncertainty, like there's reasons, there's so many stories, so much rationale for why things are that cheap. And you don't know if it's going to go down further. You don't know when it's going to come back up, but you have to invest despite the chaos without knowing the outcome.
Mm-hmm.
But there's a good story behind it. Can I drop this is like 2 full sentences from this.
Please do. I might have
a
few paragraphs to read. I'll try and shorten them.
Oh, yeah.
This memo is great.
Hopefully I'm not stealing one of your thunders here. I want to say right here about 2008 and the other crises I've invested through, as well as today, that I don't reach my conclusions with confidence or act without trepidation. There's absolutely no place for certainty in the world of investing. And that's particularly true at turning points and during upheavals. Holy matrimony. The fact that you have Howard Marks, one of the greatest investors of our generation, say, I don't reach my conclusions with confidence or act without trepidation is awesome. That says so much, I think, to the rest of us.
I mean, that's why he's a great in my eyes.
Yeah. Oh, what you got?
All right, I'm trying to shorten down this one, but it's going to be a little long. He's talking specifically about tariffs, and he says, why have Americans been buying imports in the first place? Because they're cheaper. And he says, American workers are often paid more than other workers elsewhere for the same job, but the U.S. products weren't good enough to justify higher selling costs. Okay, just pause. Think about that for a second. So we get paid more. It's so funny. There's a good friend in my office. He owns 3 chemical production facilities, one in the United Kingdom, one in the United States, and one in France. When we walk through his staffing needs and cost per FTE and all these other metrics, right? And just talk about how he's investing across the world. We come back to the fact that hiring almost, in some case, PhD level folks in the UK is cheaper than borderline entry level folks in the US. Do people fully realize that? Do they realize how you could get, and this is the United Kingdom. I mean, I'm not talking about some third world country in Africa, right?
Yeah.
That really matters. So then he goes on to talk about Volkswagen specifically and everything else. In spite of all these changes with trade headwinds, the U.S. has gotten extremely wealthy since 1950. He just does a brilliant job of articulating this, I think. It's so well done.
It's beautiful. Yeah, fully agreed. There's a lot to talk about. Maybe we're actually going to probably touch on this a little bit when we get to one of the listener mail elements, what you just said about the U.S., specifically U.S. in the 1950s, and differences between then and now. We'll get to that in a little bit. So just stay tuned, folks. Back to the memo. Can I drop one now?
Yeah, please.
Yeah. But we also have to bear in mind that deciding not to act isn't the opposite of acting. It's an act in itself. The decision to not act, to leave a portfolio unchanged, should be scrutinized as critically as a decision to make changes. Love it. This applies to so much in life, in my opinion. Would you make that same decision today? Would you invest in this stock right now? If you were to buy this stock right now, would you invest? Because what you're saying is, I want to hold the stock in my portfolio. That's what you're saying by not doing anything. I love it. Love it.
And in our quantitative portfolios, this is easy. Answering that question today is more difficult than answering that question at any time in the past 15 years for me, because I literally don't know what tomorrow holds. This is fun. This is what I like about investing. It's all good. I'm not complaining, but I'm just saying it's a way more difficult environment than it typically is.
Yeah, it's way more, because there, in a lot of ways, is like a single point of, I don't want to say failure. It's not like a single point of centrality of decision making.
Yes.
And that's odd. I think it's going to shift. I feel pretty good about that. I think it's going to shift.
Well, I don't make predictions on the show because it's stupid, so I'll leave that to you, Doogles.
Yeah, please do. Please do.
All right. He ends the memo, and I'm happy to talk about anything else. One, the memo is available via podcast. It's available to read. Just take some time. If you're at all interested in investing, this is man, I would pay $100 for this, more. There's so much wisdom here. But he concludes the memo by saying, I consider the tariff development to be what many soccer fans would call an own goal, and goes into the details. And what I loved about this is after he did a bunch of research, considered all sides, talked about the pros and cons, said a lot of the talking points for what tariffs might accomplish are admirable. They just probably won't accomplish those things. So he wrapped it up perfectly in my eyes.
And he touches on the risks, which are also pretty real.
Extreme.
And more likely. Yeah,
yes.
More likely, in my opinion. Do you want to transition to listener mail?
Let's do it.
All right. Hit that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
Okay. We're going to start off with this one's probably going to be pretty quick. John, thank you for sending this in. Appreciate it. The NASDAQ and the New York Stock Exchange are pushing to move to a 24-hour trading day. It's either going to be 5 days a week, 24 hours, or 7 days a week, 24 hours. This is going to map to what crypto is doing. What do you think about that?
John, shout out. We appreciate, John's our NASDAQ representative, sending us all the stuff, insider info. We appreciate it. But John, this is idiotic. Go beat on the CEO's door right now. Tell him this is stupid. I fully understand why. It's like competitive pressures are out there. People at 3 a.m. after having too much to drink want to trade something, and you want to make money on that. Fully understand.
Yeah.
This is idiotic. No, my parents used to say, in my late teens, they used to be like, nothing good ever happens past 2 a.m. In the stock market, in trading, nothing good ever happens past probably 9 p.m., 8 p.m. I mean, that it works fine as it is. I think this is idiotic.
Noon. Nothing good happens past noon.
Happens in the afternoon, Doogles.
Thank you, John. I agree with that take. I'm not even going to just stop it.
John, hook me up. Send me a meeting with the CEO of NASDAQ. I'll talk him out of this in no time.
Okay. Next, we got this piece. Thank you, Josh. We got this piece. It's a third way piece. It's called Having a Stake: Evidence and Implications for Broad-Based Employee Stock Ownership and Profit Sharing. Employee stock ownership plans, ESOPs is for short. So we might drop ESOP. Might say that a few times. So just so you know, I want you to start so I could come over the top and just boom, boom, go for it.
I love employee ownership. I think it's a perfect way. You go back to Munger, I think this is a great way to incentivize people so you're all rolling in the same direction. There are some really cool startups in this space that make this happen. One is called Common Trust. They like come in and help you sell the company to your employees. It's really cool. I deal with this monthly, at least quarterly, where I'm working with the founder CEO who is trying to incentivize their employees properly. The pushback I'd have on this, Josh, is the article is kind of all roses, and not all, but it's like, this is great, do this. And in actual practice, it's pretty dang hard. There's tax consequences. There's all these things. And so fix that. This is my appeal to Congress. I was appealing to Congress last week. Make this easy to do and everyone wins. But right now, I don't see this being something that's easy to implement.
There's another part of it too. There's another part of it. So, we done talked about Thomas Piketty on here a few times. His book, Capital in the 21st Century, talks about how capital is what leads to wealth. Income, wages does not lead to wealth, generally speaking. And it's capital. The way that capital is structured in our economy right now leads to inequality. Not good. If you can spread out more capital ownership, stock ownership, inequality is more likely to decrease. That leads to a healthier democracy. It's all good. I believe all that in the macro, which I believe you do too. So everything that you just stated around, you spread out the ownership, that's good. People owning, they're more productive. That's what it talks about. We're more productive. We feel like we owned a business. We think about the business in a different way. All that is theoretically true. But in addition to what you said around it being difficult, that's what I heard at least, for businesses, there's like a lot of reasons for businesses, individuals don't understand it. The number of people that have come to me in very senior level positions at startups that are like fighting for equity and then say, but I actually don't know what I just argued for. Like, I know I'm supposed to have it.
Someone told me it might make me rich. Like, that's all I know. This is my
I know I'm supposed to have it. I know if I'm going to have it, I might as well have more of it, but I don't know how it works. Can you please explain it to me? I have put together presentations for people that are like, Sally starts a company. That company needs to establish shares. Let's say there are 100 shares. Sally owns 100 shares. Oh, Sally's product is good. Sally now needs to grow the business. To grow the business, Sally wants capital. You can either get, right, like have walked people through all these things. And this is not a knock against people in general, because this stuff, as we were talking about with tariffs, it's complicated. It actually is pretty freaking complicated. And when you get into the tax consequences, when you get into, is it options or RSUs? Like, there's so much that ends up being complex that it's hard for folks. And so the theory I really love.
Well, the dilution piece in the startup world is like, oh, I used to own 1% of the company, and then, oh my goodness, they issued a bunch more stock. I don't own anywhere near 1% of the company. I don't think people understand that as well. Doogles,
that's right.
There's that side in the startup world. There's like the Main Street world too, where you might have people come to the CEO and be like, I really am invested. I want to be an owner. I want to do all those things. And you say, this is great. We want to be aligned with our incentives. And then you talk through not only the tax consequences, but what happens in a down year and who bears that risk. Because if you're losing money and you truly have common equity, everybody's losing money. And who's going to sign for the loans that happen? Like, people don't understand that either. They think it's all roses and sunshine. And then when uncertainty goes to 25-year highs and the economy twirls into a recession, like, as an owner, you have to deal with that. So I just don't think this is easy. I wish this was easy to implement. But to your point, I think at least 75% of people don't even understand what it means. And then there's a greater percentage of people that don't want to deal with the negative risk.
That's right.
It's complex, man. I don't think I think the reason equity is not shared as frequently as we wish it was has a solid foundation behind it. Can you say that a better way? I mean,
no, that's pretty good. That's pretty good. All right, want to go to the last one?
Well, I didn't mean to steal your thunder there. Did you get all your thoughts out?
I got the main gist of it. I'll summarize. I love it. in theory. And actually, I think I've only really ever worked for companies that had some sort of stock ownership or profit sharing. Like, so I have seen all of this, and I love it in so many ways. When things are up and to the right, it is phenomenal.
Amazing.
It's beautiful. You have people that can buy homes that were never able to do that otherwise when it comes to just wages. Like, it's absolutely amazing. The downside, because that's when people start looking at the fine print, right? When the downside starts to come, they're like, wait, what? Hold up. No. And I think that's where it becomes really tricky, because people don't fully understand. They don't fully get what they have necessarily bought into, which is not a fault of their own. It's just really complicated. That's the summary. Okay, last topic. And this came from a few different angles, by the way. I got this from a few different angles. We're going to talk about bonds. Now, neither Skippy nor I are we're not Howard Marks. We're not bond experts, debt experts. The way this came through to me was not about, should we buy bonds, what bonds to buy? It's not about that. It was, what is going on in the bond market, and what does that have to do with the current state of the economy? And I want to throw out a few things that I think it's really interesting. So first, this is my interpretation of what happened just this week. The leader of our country, just like the leader of the UK back in the day, came out. He said, we shall go to the end. We shall fight in France. We shall fight on the seas and the oceans. We shall fight with growing confidence and growing strength in the air. We shall defend our island, whatever the cost may be. We shall fight on the beaches. We shall fight on the landing grounds. We shall fight on the fields. We shall fight in the streets. We shall fight in the hills. We shall never Wait, what? Are they selling bonds? Okay, actually, no, we good. Let's go ahead and reverse course. That is what happened in this past week. Here's the analogy I'm making. There was we holding our ground. Like, we're the U.S., baby. You want to deal with us? Tariff for you, tariff for you, tariff for you. Then the bond vigilantes, which is like a gray, dark corner that no one actually can fully say definitively what's happening. But the bond vigilantes strike again. Here's what that means. So the bond market is ginormous. I actually don't have the numbers. I should have pulled them. But the bond market's much, much larger than the stock market. And bond yields, as we've discussed this, but I'm going to say it again, bond yields and bond prices move in different directions. If you are curious as to why that is, we're happy to answer it. SkippyDoogles@gmail.com. Shoot us a note. Happy to answer it. But just know it. Bond yields and bond prices move in opposite directions. So when bond prices go down, which means that people are selling bonds, just like in stocks, you're selling bonds, so bond prices go down, yields go up. Long-term bond yields correlate to things like mortgages, things like credit card interest rates, right? Just the payments that actually hit consumers. So what happened was there was a big spike, like 65 basis points spike that happened nearly overnight in the bond market because somebody started selling.
Yeah, okay. You're sounding like a finance nerd over there, so I'm going to reset. So one, bonds or debt, stocks, equity, ownership. Okay, there's those two basic things. Bonds or debt. The most common bonds you hear about are U.S. government debt, your municipality's debt, but there is corporate bonds as well, right? Doogle's point here is correct. There's generally a supply and demand happening. There's a lot of speculation around what increased bond yield this week. And again, increased bond yield means decreasing bond prices. There's a lot of reason that's challenging when you appear to be trying to blow up the U.S. economy. Okay. First is, if you hold a 60-40 portfolio, 60% stocks, 60% ownership of businesses, 40% ownership of debt, those assets typically aren't that correlated, right? So when stock prices go down, you kind of expect bond prices to go up, and it acts
People
as a
are looking
nice
for
hedge.
safety. People are looking for safety.
Right?
Yep.
And reduces volatility of your portfolio, which makes it easier, theoretically, to hold through tough times. So when bond prices when stock prices are all over the place, 3% down, 5% up, whatever is happening with the crazy uncertainty, you'd like for bonds, just from an investor's perspective, to be plugging along, to be thoughting of the safe asset that they typically are, and for the price of bonds to be increasing, which would mean the yield is decreasing. The exact opposite happened this week. Because where I want to emphasize, I'm not an expert, is I don't know exactly why. There's lots of speculation that the selling comes out of Europe, but China holds a lot of bonds in Europe, a lot of U.S. treasuries in Europe, so it could be China. It could be 1,000 things. Really? You're going to laugh at me. The lesson here, it's not really about bonds. It's not really about stocks. It's about, like, teaching my 7-year-old to be kind to his friends. Like, we just pissed a bunch of people off. That's all that happened. I don't know who's selling. I don't know exactly why they're selling. I do know exactly why they're selling. It's because they're like, why are you guys being jerks right now? That's the entire thing. There are some countries in the world that are much riskier than the U.S. that currently have a 10-year bond yield lower than the U.S., which would normally imply that it's a safer investment. It's clearly not a safer investment. It's just a more friendly partner right now. And if you alienate all your partners, people are going to react. This is rational, right? Doogles, if you and I go out to dinner every week and we occasionally, whoever pays for lunch.
Are we going to do this?
Right? We're going to do this.
Is this an invitation?
And then you just start throwing tomatoes at my head. Do you think I'm going to still cover the price of your lunch? Like, no.
Yes.
This doesn't make any sense. Just be kind.
Terrible analogy, because yes, I would still expect you to cover the price of my lunch. This is the trade that we made as a country over the last 70 years. The trade that we made as a country was this. We are going to give away a lot of the industrialized part of our prowess as a nation for financial control. We became the financial center of the world. We run trade. We have the dollar as the reserve currency. We talked about that in trade deficits last week. One of the things that is a decision point for us, as we are strongly pushing to say we want to go back to being more industrialized, is that just like with the ESOP conversation, there's a trade-off now. So do we want to give up being the financial center?
Wait, you just said we want to be the
U.S.
more industrial nation, and I'm not in that camp. No, I'd like to make the best wages in the world. Just in case I had to vote on that one.
No, but therein lies the conversation, because that part of the conversation is not happening. We discussed the U.S. dollar as the reserve currency, because we are financial strength. People own dollars. When they own debt, they own dollars. People have dollars everywhere. Trade deficits, they own dollars. So what I'm saying, people, is because I do believe we should have more manufacturing in the U.S. than we have now. More. That's different than what's happening, what's being said out there. I'm just saying more. But if you fully want to go that direction, then the people that have the dollars are going to go, cool, okay, so I just won't have U.S. dollars anymore. I'm going to sell your bonds. I'm going to spike your interest rates.
Because there's other alternatives.
We don't want that either? What do we want? Which one do we want? And that is like a decision. And that is not being contemplated fully by the high-level narrative that's being put out there. So you cannot cake and eat it, baby. Cake and eat it, baby. The whole thing here is trade-offs. And if you want to be the manufacturing center, you give up your wages. You give up the high standard of living. You give up the reserve currency. Now, cool. Welcome to 1913. And I'm telling you right now, I ain't going back. I ain't going back to 1913.
No comment on that. That's a depressing. Yeah, I don't want that.
We do get the roaring 20s, though. You know what I mean? Like, you remember that? Remember people who were doing their Jap flapping or whatever it was?
Our tariff legislation came in 1930, so just align those times, right? We don't even get the roaring 20s.
We go straight from 1913 to 1930 and
Pretty
skip.
Much, yeah.
Okay, I guess we skip World War I. That's okay.
Love it. We appreciate the listener mail. Thank you for sending it our way. If there's follow-ups, please go. I mean, Josh, if you want to have a 3-hour debate about ESOPs, let's do it already. Other than that, no Inside the Trade this week. Hit us on all the usual platforms. Everything for the show is skippydoogles.com. And we'll talk to you next week.
Bye, everybody.